Good afternoon. I'm David Luberoff, the Joint Center's Director of Fellowships and Events, and it's my pleasure to welcome you to the first of our fall housing research seminars. Today we'll be listening to Dan McHugh providing some updates and on findings from the most recent State of the Nation's Housing Report. Before I introduce Dan, I want to let you know that this is the first of what is shaping up to be a very exciting and very busy series of events this fall. Illustratively, in the next month alone, we'll be hosting or co-sponsoring events on a wide variety of subjects, including the state of housing design, efforts to help cost-burdened middle-income renters, using housing policies to foster connections in diverse communities, rethinking our narratives about people who are experiencing homelessness, and how we might create more effective, comprehensive, and accessible home repair programs. Later this month, we're also co-sponsoring Hack-A-House, a 24-hour virtual competition that gives students from around the country the opportunity to develop and pitch innovative ideas to make housing more affordable. 3 winning proposals will share a total of $12,000 in prize money. More information about these and a host of other events are available on our website and in our weekly emails. Now on to today's talk. Before I introduce our speaker, I want to say just a brief word about the report. The State of the Nation's Housing Report has been produced annually by the Joint Center since 1988. This is the 37th State of the Nation's Housing Report. It has been and continues to be a significant and trusted source of information used by policymakers, practitioners, advocates, and others interested in housing. And right now, housing is getting a huge amount of attention. In fact, last week, probably for the first time ever, housing came up in the first few minutes of a presidential debate. So it's a particularly good time to review the state of the nation's housing, and there's no better person to provide that review than my colleague and my friend Dan McHugh, who for many years has overseen the Joint Center team that produces this important report. Dan's going to take about 40 minutes to review the report's key findings and in a few cases to discuss data that's come out since the report was released in June. I'll then moderate a Q&A, drawing in large measure from the questions that you can submit using Zoom's Q&A feature. Apologies in advance if I don't get to your questions. We'll end as close to 1:15 p.m. as I can. Videos and slides of this talk will be posted early next week. And to remind you, a host of materials about the State of the Nation's report are already available on the Joint Center website. Dan, it's all yours.
All right, thanks. Thank you, David. And thanks everybody for tuning in to this first housing research seminar of the school year. I'm happy to kick it off with this presentation. Maybe introducing the Joint Center State of the Nation's Housing Report to some people and kind of giving others a little bit of a reminder of what's in the report over these next 40 minutes. Happy to share these with you. And so what I'm going to do for this presentation is kind of review just the major themes that we had in this year's report. It's a report, it comes out every year in June. So it gets us through the beginning part of the year, but there's been some changes that I'll go over in terms of some of the data points and some of the storylines, but really the themes have remained very much the same over these summer months. So just namely kind of the overarching number one theme that we still see is just the extent to which rising housing costs and affordability issues are weighing on households in the country. Another theme is specifically for homeowners and potential homeowners is just the big rise in costs of homeownership with the combined increase in home prices and the still high interest rates. And although that is one part of the update, since the report is that interest rates are starting to show signs of trickling down a little bit. So see what that means, what effect that those movements in interest rates have had on affordability for potential homeowners. Also, kind of going to be reviewing the impact, the recent trends in rental markets and how the kind of surging supplies, the number of units being built is affecting rents and vacancy rates and just the overall conditions for renters and for landlords in 2024. Going to do an update on just the overall still rising demand. So demand meaning the increase in the number of households being formed, just the changing shape of demand and what types of housing units are being needed and what's driving that. So we have a little bit of an update on that, which is a big part of our report. And then a review on what all this means for housing policy. What are the major challenges ahead that all of these new updated data points, what did all these storylines mean in terms of the big picture issue? So we'll step back and kind of talk about how this all fits into the bigger context of housing policy challenges and see where we are in those issues. So we'll start with the rising housing costs. Our primary concern here in the report is just the impact of rising costs. And just to get a picture of what the costs are for homeowners and renters, we look, very, very simply at rents and house prices, right? And so we see here rents in the orange and house prices in the darker color, really having ratcheted up, during the pandemic years, probably between around 2020 and 2022, we saw a big surge in both costs, and it's really left both metrics elevated. There has been no real return back to trend after this big surge. So we're seeing people looking for affordable rents, really seeing the legacy of this increase in rents that has put them about 27% above where they were just 4 years ago, entering in 2020. House prices 50%, closing in on 50% higher than they were 4 years ago. 50% increase in house prices since early 2020. So these are big picture, big moves that are really weighing on households, as I said. Our primary indicator that we track over the years, over the months, for owners and renters is housing cost burdens. Now, the 2023 American Community Survey is where we go for this information to compare how many renters and owners are paying more than 30% of their incomes on housing costs. And we saw, as we pointed out, both in our State of the Nation's housing report and our rental report, that the number of renters reporting cost burdens hit a record level in 2022. New information from the American Community Survey in 2023 shows another new record. Even before this, as we head into this plateau in rents and prices, we were at kind of near record levels of cost burden for households overall, record numbers of renters cost burdened, and a huge surge. It may not be quite as apparent here, but a surge of 3 million additional homeowners cost burdened between 2019 and 2022. So indications that there's stress out there. I mean, especially for homeowners in a period where interest rates were declining through 2022, and refinancing was happening, and homeowners were able to kind of lock in historically low interest rates. We were still seeing rising cost burdens, and I'll tell you a little bit about how that happens in a couple slides. But when we look at renters, this is the changing cost burden rates for renters by different income levels. And so the story of renters is these increases have really pushed burdens for low-income renters to very high rates. Over 80% of renters with household incomes below $30,000 are cost burden. And the majority of those cost burdens for low-income renters are severe burdens, where renters are paying more than 50% of their incomes on rents. But we also don't want to forget and want to point out that the biggest surge in cost burdens, the biggest growth in cost burdens is among these middle income renter household groups. Median income of renter households is just under $50,000. So we see this group right here in the middle of our chart rising rapidly. The most rapid growth is in the cost burdens among middle income renters. And so what this is doing is this is putting rent burdens, rental costs, housing costs, really on front, becoming front page news. It's hitting more and more people. It's not just a problem, faced by low income households anymore. It's a problem that's increasingly hitting middle income households, bringing more attention on middle market issues that we're going to be talking about. There's going to be presentations that David mentioned next week and the week after. So looking at that, but politically, this has brought a whole lot more attention. Part of why it's being mentioned at presidential debates is just that the so many people are now being affected by cost burdens. And for in the renter side, a lot of the cost burdens are due to this. The fact that we're losing moderately rents units with moderate rents. So here's kind of the distribution of the whole rental stock by rent level, and we kind of see this kind of curve where we have a lot of units in the $600 to $999 range. But even if we adjust for inflation and we kind of go over time and we catch this up to 2022, we see, over the last 10 years, we've had a loss of over 6 million units renting for under $1,000 a month. And these are the units a typical renter, the median income renter, needs to not be cost burdened. So we're losing units on the low end of the rental stock, and we're gaining units really at the highest end. So as we lose 6 million units under $1,000 a month, we've gained 4 million units renting for $2,000 or more. It's not a bad thing to gain units with high rent, as long as there's also gains in units with low rents, the kind of rent filtering. And we've seen through recent research that the filtering process, when there's a shortage of rental units, the filtering process really slows down and even can reverse as these low rent units can get investments, can get moved to the higher end, to satisfy higher end demand. And that really leaves low income renters with really less to choose from, and a lot of times just the elimination of naturally occurring affordable housing in many markets. When we look at, this is cost burden, we're switching over to looking at cost burdens, this growth in cost burdens for homeowners. And it's kind of a different story. We see kind of a reduction in rent or in monthly housing cost burdens for higher income homeowners who've been able to kind of reduce their mortgage rates and things like that over through 2022. But we look and see that the problem is increasingly concentrated among the lowest income homeowners. I mean, these are not homeowners who are just getting in, low income new homeowners who've kind of gotten in over the head. These are by and large longtime homeowners with limited incomes whose housing costs have been rising. I mean, this has been a story through whether it's insurance costs, which have been rising at record levels. We document in the report, average growth over the past year in insurance costs about 21% for insurance premiums, in 35-40% in some states. Property taxes as well growing with the rising. It's a great thing that for homeowners when the value of their homes rise, but it also, that's a little bit harder to tap into, whereas you get this immediate effect on raising your property taxes. And so average property tax increases of 4% for homeowners. It's an average property tax annually of $4,000, which is a big chunk of change if you're making $15,000, $30,000 a year or less. So these are changes that can really be impactful to the month-to-month burdens that low-income homeowners are facing. So this is an area of concern that we point out in the report and spend a good deal of time explaining. So that's the primary theme, the theme of affordability that we cover throughout this year's report. The next theme I wanted to talk about was really just the home buying part of this, the push, the very I guess there a lot of interest, I guess, for lack of a better word, for my brain, which is just shut off right now. And in just the impact of these rising prices and interest rates on the ability to attain home ownership for so many households out there. And so, following in on our storyline from this year's report is that, not only have home prices remained high with the surge in interest rates, but they continue to grow. Declining only briefly in 2023. Home prices ended 2023 up over 5.5%. Home prices this year alone, since January, home prices are up 4.6%. So 4.5% increase in home prices over the course of the year. And so this is really keeping affordability levels very low. It's kind of cutting into the gains that we've had for these recent declines in interest rates. And so just kind of putting out some of the numbers for you. We have updating one of the charts. We have this table similar to this in our report this year, just documenting kind of the underlying factors behind housing costs and how people are being priced out of home ownership. And we see how between January 2024 and just updated to the latest numbers, this decline in interest rates, Freddie Mac reporting interest rates this week had come in, declined down to 6.2%, lowest in a while, right? But we see that the impact of these this decline in interest rates has really been offset by the rise, the 4.5% increase in home prices over the course of the year. So that when we compare current prices with and current interest rates, the payments are actually higher. So we still have the payments on a typical first-time buyer loan would have gone up between now and January, even factoring in this latest interest rate movement. So really the impact on affordability, and affordability levels are still very low for so many potential buyers. And I just wanted to point, what this chart also shows you is that the amount of money you would need to be able to qualify for a loan, upwards of $120,000 to be able to afford to purchase a median priced home. And very few renters have that. We see out of the 43 million renters or so, we talk about in the report how only about 2.5 million, so less than 3 million renters we see have the required income and the required wealth, about $25,000, in wealth, to be able to purchase today's home. So less than 3 million out of 42 million, renters. So it's really, raising the bar and pricing out so many homeowners or potential homeowners looking to buy. Just the fact of what that $3,000 a monthly payment means, it's just astronomically high, a record. This on the left, we see, the payment of over $3,200 in the first quarter of 2024, $3,200 a month to afford the median priced home under typical first-time buyer loan terms. And so, I mean, comparing that to what we've seen in the past, well above what it was in the mid 2000s when we were, in a real housing boom back then. So just kind of putting this in context, it makes homeownership attainability so unaffordable across the country, taking more than $100,000 a year to afford the median home in most metro areas now. So it's really cutting off access, and cutting off access to millennials, Gen Z, young adults coming up looking to buy homes, but also really a big hindrance to all the efforts being put into kind of making homeownership access more equitable and reducing these these persistently wide gaps in homeownership by race, kind of leveling the playing field. Just kind of, I can't, it just was one of the shocking things in producing this year's report, is just not only how wide the white, black, and the white Hispanic homeownership rate gaps are, 27 percentage points, 25, almost 25 percentage points gaps with Hispanics and whites, but that the lack of progress. We're looking at the homeownership rate gap of black and white households in the first quarter of 2024 was exactly the same as it was in the first quarter of 1994, which is the first full year of this housing vacancy survey that I was looking at that we see here. So, 30 plus years, and we're at the exact same level of gap in home ownership rates between white and black households. So really putting increased pressure when access to home ownership is so unaffordable. The special purpose credit programs, the homeownership, down payment assistance programs, those things are all stressed to do even more with higher prices and higher costs of lending. So it's just a concern that we kind of focus on for a large part of the report as well. And so what's behind all of these? Why are prices still going up? Why are things so unaffordable in terms of home buying? Well, the first is this still low level of inventory. So here's a picture of inventory, both in terms of number and then comparing it to the sales rate. So you get a month's supply of how much month supply of homes for sale are out there. And it's just recently gotten above 4 months of supply. But we see this is where there's been some progress since the report was published. Inventories are up about 20% year over year now. So we're building inventories, but they're still, looking at this longer term, inventories are still 30% below where they were in 2019. So 30% below pre-pandemic levels, because getting back to pre-pandemic levels, we were already back then talking about how little inventory was out there. So we're just now recovered from a historically bad to just really bad low levels of inventory in terms of pressure on upwards pressure on prices. Prognosis for how those inventories are going to be built, well, construction is one, which we'll get to in a minute, but we've looked in on the issue of mortgage rate lock-in. And so I was talking about the interest rate having declined to 6.2%, which you see kind of in this line here is the market mortgage interest rate. But still, the latest data from the second quarter of 2024, the typical mortgaged homeowner has a rate of 4.1%. So still over a 2 percentage point difference, a gap between the interest rates that current owners are having on average and market rates. So if you have a market rate, you're going to be increasing to get to market rate, if you're an average mortgage homeowner, you'd be raising your interest costs by 50%. So it would be a big jump. It's still a big factor, and it's it's a long, most owners are a long way off. So these smaller, you'd need a big, I guess the point is you'd need a big decline in interest rates to get them close to what the typical owner, and we haven't yet gotten that. So it continues to play a role in housing market dynamics today. One of the other updates, construction is another way. Getting construction to catch up to demand is another way that to help build inventories. But one of the updates that we've made here is that back when we released the report, we were looking at single family construction rising as a result, that what we describe as a result of just this overly tight markets for existing homes. Just the lack of existing homes for sale really brings people to consider new homes, in addition to the ability of new home builders to alter, to give some financial benefits, such as the ability to buy down, mortgage rates, the ability to kind of adjust the product a bit, to make them more, just the overall more large, higher flexibility that you'd have, in designing a new home to be more affordable than you would from having to choose from what's out there in the existing homes. But that's since kind of tumbled down. So, new single family housing starts really dropped in July A signal to us really that affordability concerns are big. They're out there. It's still an expensive product, a home, and it's still on average going to take a borrower with more than $100,000 in income to be able to afford. So it's still suffering from the same issues that the existing homes are. And this latest the latest movement really seems to kind of put that make that point to us. Moving on to rental markets. Rental markets, the overall softening of rental markets. We see here how here's the rents that you saw earlier in the line, but the kind of pace of rent growth over time had been astronomical pace of rent growth in 2022 as we kind of saw a pandemic-driven surge, late pandemic surge in people looking for rental units, low supplies. But as the supplies have come online and demand has eased a bit, we see rent growth slow down to being basically flat. But note that rents nationwide are not going down yet. So that's why we have this kind of plateau in nationwide rents, which means we're plateaued at a point where rents are largely, rents are expensive for so many households. It's not the same. I mean, there's a large divergence of rent growth in markets across the country. Some declines in areas of the South that have seen, both a larger construction levels, whereas continued growth in rents in places in the Northeast and Midwest, it didn't see quite the same response in terms of construction. But it's also, how can we have so many places with declining rents and still have level rents overall? And the fact that a lot of the places, this will show kind of rent growth by region, and a lot of the places with large rent declines are those same places that saw the biggest increases in rents during the surge in 2022. And so that leaves us with everybody's rents being expensive, being above, nationwide rents being 26% above where they were, heading into 2020. So it's kind of a situation where we're seeing some pretty big pullbacks in the places that saw the most heated conditions earlier. So it's really left nationwide kind of still in an elevated state in terms of rents, and that's why we have continued pressure on renter cost burdens. But still, that being said, declining rent growth is putting landlords under pressure because costs are rising, and so we focus a bit on the cost of insurance that are a real struggle for landlords. And in addition, and in particularly landlords whose incomes are constrained anyway, such as those for rent restricted units, nonprofit affordable housing landlords are really being constrained and seeing this rise in insurance rates really cutting into their ability to not only be profitable, but to kind of offer the services that they need to offer as a landlord. So it's really kind of hampering the rental markets. It's making the numbers less likely to pencil out for new construction. So when we look at rental construction, not only are we dealing with kind of a big surge in units coming online now, but we also have the condition where costs are up and revenues are down, and new developments aren't looking as profitable and therefore not going forward like they were. So it's really leading to new projects, a real lack of new projects that we're worried that's going to come, that's going to potentially be a problem if, given the pipeline, the long pipeline, the long length of time that it takes to get from concept to permit to start to completion on a large multifamily property. It's a long, it's a long time span, and so if things get too low in terms of the multifamily construction, we worry that it could lead to a situation where where we're just supplies are again lagging behind growth and demand. And I mean, part of the reason is that is if we look at a simple look at supply and demand in the rental market, the softness in rental markets does not, it seems it's not due to a drop in demand. We can see here the orange line is the change in the number of apartment households in apartments. So it's basically apartment renter household growth. So that's your demand side, kind of charging ahead. So it's not in a downfall. So we're still seeing really solid growth in the number of renters out there. It's just being outpaced by the number of new completions that we saw as this kind of large, the large buildup of multifamily construction that's really getting completed now in large numbers. So long story short, demand is not suffering. Demand is still large. So if supply growth tumbles too far and demand stays strong, it's going to put us in a situation where rents are going to be pressured upwards again in the near future. As I said, demand looking a little bit larger. Demand overall, here's year-over-year change in households. So updating that to the first quarter or the first half of 2024, still really above average growth in pace of growth in households. So new demand staying strong. A lot of that is in the rental markets. The latest housing vacancy survey showed, over 800,000, new renter households over the past year. It's a quarterly number. It's a little bit volatile, but it's still strong growth in households. A lot of it is in renter households, despite the affordability issues. We have just large demand. We have the demographics for demand are very strong right now, and a lot of it is, the emergence of Gen Z, who we can't forget is actually started out as the largest generation, larger even. You can see here, looking at the births, more Gen Z generation births. They actually peaking in year 2007. So the peak birth years are generation. The cohort is actually 17 years old, in 2024. So a real kind of baseline of support in the demographics currently that's helping out rentals, helping keeping demand strong. The other the other factor here is the surge in immigration, which has eased since 2023 or in latest months. But that has been a huge factor in terms of demand, not easily measured in a lot of the survey data. But here's a look, from the CBO, just showing how much immigration, which had been around 700,000 a year, for 10 years, 7, 8, 900,000, spiking to 2.5 million in 2022, almost 3.5 million in 2023, estimated similar 3.5 million in 2024. So big ramp up in immigration, playing a role in keeping the demand side of housing strong, and affecting things in ways we're still struggling to measure. So that gets us to the kind of final section. I want to talk about the challenges ahead in housing policy, and the way the surge in demand that I've kind of just described is adding to these long-term issues of shortage of housing, housing supply. So I just want to kind of show you another look at supply and demand, and how the underpinnings of how you get to a shortage of housing. Not necessarily, we've had other groups, lots of organizations we talk about in the report coming up with estimates of how many housing units are we short. It's 1.5 million all the way up to 5.5, 6 million unit shortage of housing. How did this happen? And we look at it and we see this, if we look at the difference between construction, which is the growth in housing stock, and growth in households here in the orange line, we can see that for decades, we had construction levels about 30% higher than household growth levels. So enough to accommodate growth in the number of households, as well as a certain about 30% of demolitions, obsolescence, a certain amount of obsolescence demolitions, replacement units, certain amount of second homes, a certain amount of kind of necessary vacancies to accommodate kind of a viable market, a lubricant market. You need some, some level of vacancy, but basically second homes and teardowns require about 30% more, more higher levels of construction than household growth. But that dissolved in the decline during the Great Recession, 2008 and onward. We saw both demand and supply tumble, but demand grew much faster than supply. And so we had a whole decade where construction levels only matched household growth levels. And now with this recent surge, we see our kind of measures of household growth is actually exceeding construction. So this is where we see, these last 4 or 5 years where the shortage of housing has been kind of more and more on people's radar. It kind of indications as to where this is coming from. It supports this increased feeling and this increased measure of a shortage of housing recently. So what's being done on the policy side? I mean, one of the positive sides of all of this negative information that I've been giving you is kind of the momentum that's building to do something about the affordability challenges. And so one thing you can do is work with the market, try to do something to get more, lower the cost of market rate housing, enable the market to build, more modestly priced units, and all the things that are being done at the local level that we see, places like Charlottesville, Virginia, revising its zoning codes, eliminate single family only zoning. Places like Cambridge, Massachusetts, or Lexington, Kentucky, removing parking minimums. Things like that, streamlining, review and approval processes. Places like Boston, making 150 parcels of city-owned land available for housing development. All these things, are starting to build some momentum. So, things are happening. Places, more states are putting on, putting incentives or even kind of penalties, or even just laws limiting the amount to which local jurisdictions can limit development. All these listed here that are preempting local zoning, so that that local areas have to kind of enable more development to help ease this lack of supply and the affordability challenges behind it. We talk a lot of our research, and on our website you can see a lot of the research we've done, looking specifically at manufactured homes as a way. I mean, here's the kind of manufactured home shipment data showing that even as a potential area, that will allow, modestly cost homes to be produced across the country, hasn't been getting, the momentum, hasn't been getting the increase since, since it's declined. The construction of manufactured homes has declined, still about, a third to a third to half of levels. So a lot of effort. You can look into our report on things that are being doing on the perception level, on the pure legality of manufactured homes, to places that don't allow them at all in single family lots. And so specifics, that we point to in our report. But we also talk about the report, the way that the market will never be able to build a unit inexpensive enough, to be afforded to certain, to a certain segment of the population, the lowest income households. Subsidies will be necessary, and just really keeping up, subsidies and somehow, reaching the lowest income households, because there's just millions of households, a growing number of households, that could only afford, units well below market, growing faster than the assistance levels are. So just kind of showing the numbers here, increase over the last 20 years of about a million assisted households, which is great progress. But the number of low income, renter households increased by 4 times, more than 4 times the amount of the assistance. So that has led us to kind of record levels of, as HUD reports, record levels of households facing um, facing worst case housing needs, which means they're severely cost burdened or they're in inadequate units or both. And so just being able to keep up with this as we kind of work our way down, reduce market costs, increase assistance, make the gap between the markets and the affordability levels as small as possible. Um, you know, looking at more ways to do this on a policy level. Another concern as I begin to wrap up is the record increase in people experiencing homelessness over the past year. And so we report on this. We look at the great insights into the complexity of the issue from people like Margot Kushel and her group, and Greg Colburn, finding thousands of faces of homelessness and the thousand paths, right, that have led people to be experiencing homeless, and talk about the complication, how the complicated way in which the multifaceted approach that needs to be taken, but also the simplicity, the parts in which there's the simple nature of it, and the attachment to housing affordability. So we look to and we cite works around the country, gains made in cities like Houston, pointing towards the crucial need for coordination of services, but also the barrier that sheer lack of affordable housing options brings and puts on on people who are insecure in their housing positions. And the final challenge really is this increasingly urgent need to prepare the housing stock, prepare our households for the changes through changes we're experiencing in climate, the increase in billion-dollar climate and weather disasters, going up from 3 per year in the 80s to 28 events alone in 2023. So damage is getting larger, more frequent, more households, 60 million homes at risk in these high risk areas. The policy issues, getting more money for climate resiliency, detaching it from recovery efforts so that you don't need a disaster to be able to have assistance, making your home more resilient, but also tracking the record efforts through things like the Inflation Reduction Act in preparing getting the housing stock more energy efficient, and the ways that we can reduce the impact on the climate by addressing efficiency in our homes, and all the things that can happen to work towards a more climate friendly and climate resilient housing stock in the future. And I think and that's it. So there's a lot. It's a whirlwind tour. Please, you probably got to this through our website, but much more on the website, including a great roundtable panel discussion that's up there. A lot of data, a lot of charts for your local area. But I think I will leave it there and see if there's any questions that were sent in while I was talking. So let me stop my share, and I'll see if David's there. There he is.
David is here. Yeah, there are as one would think, many more questions than we have time, and let me sort through at least a couple that really did jump out at me. We had a bunch of people asking about insurance, and really a two-part question. You gave us sort of the percentage increase in insurance costs. I don't know if you can put some numbers behind that in terms of rough guesstimate as to what are we looking at, and more importantly, a little bit of and I think we know the answer to this, but just want to make sure we get it right. Why insurance costs are going up so quickly?
Sure. And so, I mean, the question was, what do we mean in dollar terms is
Yeah,
the 20%? I mean, it's anywhere from a few $100s to $1,000. I mean, these are things, I think the main point there is that people on the margins, right, who've locked in low interest rates, and not everybody used low interest rates that we had in the past, to lower their costs. Some used it just to get into home ownership, right? And some were kind of struggling. Some maybe needed, so I really wanted to stress that, at the margins, these may not, these may seem like a few $100s, but a few $100s puts a lot of households on the edge, and especially when we look at those numbers of cost burdens back in 2022. So before, I mean, the numbers I had for growth in, insurance costs were from 2023, and 2024. So it's, these are costs that have risen. So that, and it put people who are already on the edge, in difficulty. So I think, as to why they're going up, I mean, I think it's a number of factors, right? I mean, I think some of them are, it was like, I pointed to the kind of increasing likelihood of a billion-dollar disaster, right? Increasing likelihood of these disasters being priced in, increasing values of properties, being priced in, that would need to be insured. That's part of that, right? That have gone up. If your values have gone up 50% in the last 4 years, you may not be keeping track as a homeowner, right? And you see, oh, what is this? And so the base value is going up. But yeah, and the replacement costs are getting higher. And yeah, and there's a lot of there's kind of international, like macroeconomic factors and reinsurance firms. I really have to give a shout out to Shelterforce, who has a whole series on this, and so I would really recommend people reading those articles from Shelterforce. I enjoyed them and felt like I learned a lot from them. But if you're interested in that, that would be my entry point from that, the articles on this, because it's really a big deal. It gets complicated fast as to why not all, I mean, policy can only go so far in terms of insurance. If the companies are international, they're not based, in the country, and when policies do kind of limit costs, we've had the problem of insurance companies just exiting markets, right? And so then we're left without any insurance. And so it's a complicated issue that I can't cover in a quick update of all the issues we have, but yeah, so there's lots of resources.
It is striking, I mean, that this issue, I mean, I don't think it got mentioned, over the many years I certainly have been working with you on the State of the Nation's housing report, that it really has emerged within the report, within the popular narratives. Your mention of kind of the role of large investors in that market sort of prompts me to ask. There's several questions about what do we know about the extent and the impact of institutional investors, particularly in the multifamily market, but during the peak of the pandemic, there was a huge hue and outcry about the institutional investors also in the single family market. So wondering, both, one, do we know anything about the changing patterns of ownership in the rental markets? And then more broadly, given what you're seeing about the costs, are we seeing any shifts in pricing, or just what investors are looking for, particularly in the the multifamily market?
Right. What I'd have to say about that is, I mean, I think we have papers on our website, right, about the increased professionalization of ownership of multifamily housing, and the increased international, like multinational, the multi-regional, at least throughout the country, of ownership, having a role in, I guess, the standardization of the product. I'm just thinking purely about rent growth and the shift in rental stock to higher end units, and just the ability now to seek out properties across the country that fit your investment guidelines, the ability to kind of tap into uh, places where you may, as an analyst, see a an opportunity to raise rents, right, or a gap, or I guess a rent you would call it, right? But it was like a way that so I think the ability to kind of seek out to purchase things so much, to find units, in markets, has really made markets seem to all be suffering similar problems, right? Tapping into markets that wouldn't necessarily um, be the subject, or be in the interest of kind of a larger group. But it's just like with the technology that we have now, the ability to kind of invest in all different markets has its upside in bringing money to markets, but it also has downsides in terms of it's a profit seeking enterprise, and it's hitting areas that aren't used to that, or may not have seen that in such a degree in the past. And it's also kind of making our markets more act similarly, I would say, so subject to the same problems. And so our State of the Nation's housing report is just reflected in so many different areas, large and small. I mean, I think there's an aspect to that that is due to this kind of professionalization in the of the rental stock that I don't have a good handle on. But I think it's something subject that we can study.
Dana, just sticking on multifamily for a second, I was struck in the one of the graphics you had put up, that completions looked steady, but it looked like maybe there was a downturn in starts, although still at a relatively high level. And I'm just wondering whether it, I mean, it may just be too soon to say, but um, given a little bit of the softening you described, are you seeing a significant slowdown, I guess, farther upstream, say at the permitting level, or is it still seem to be holding relatively steady?
Yeah, I mean, permits and starts all down, double digits, and just a very, very few units kind of being proposed, compared to the past, especially. But yeah, so I mean, I think the two elements there is it takes at least 2 years, right, to get these projects going and completed. So it's a long lead time needed. Seeing the new stuff tumbling, we see, because we're seeing, right, completions are still rising, are still pretty high, but that's stuff that was permitted, 2, 3, 4 years ago, and so it's kind of a big train that has to turn. And so right now that train is headed south, right? And on the next slide I showed, like, demand was still pretty strong. So and it's rents aren't tumbling across the country, right? Across the country, in average, their rents are stable. So this growth, in demand is really absorbing, a lot. Maybe not in every market the same way, but it's absorbing a lot of this surge in units, without a nationwide tumbling of apartment rents. And so what happens, when we start to feel the effects of the drop in permits and starts and stuff,
I
if
was going to
demand
say
stays strong?
it looked. I suspect if we're back here next year, which I hope both of us are, um, we may see a different graph there. It does lead to sort of the puzzling question, and I think you and I've had this conversation on and off often about how is it that the costs keep rising, given the cost burden numbers suggest that costs are rising faster than incomes, and yet household growth remains apparently strong, although maybe that's just a function of how big the we're right in the midst of the millennials and the Gen Zers coming. But it does seem like if costs stay high, supply doesn't increase. It does seem like that ought to dampen demand, but that doesn't seem to be happening. Or am I missing something here?
Oh yeah, no, I mean, my thinking is that it is dampening demand, but we have demand. We also have kind of a slowdown in, or expensive home buying, right? So first time home buying numbers have plummeted as well, right? So kind of the reduced flow into home ownership out of rental is kind of building, rental units. So it's kind of more people are staying as renters over the past year because it's just been so hard to so expensive to buy a home. We have, so that's part of the growth in renting is just a decline in losses,
Hmm.
right? And so that's part of the thing. But we also do have rising cost burdens. People are getting into the rental market, but they're paying more.
Yep.
They're having to pay more. So we have this need, and what we don't have in this equation is this big group of Gen Zs, this big group of millennials, are they, didn't mention, it gets a little bit too technical, but are they, forming households at the rate that they would normally, right? I mean, they're a big group, they're forming lots of households, but what we're at now, maybe this represents, depressed formation from this group who would otherwise, in a more affordable environment be much more housing independent, right? So yeah, it's a little bit hard to measure, and but yeah, it's a
I think
combination.
I think I remember you doing this calculation a couple of years ago, and it's a hard one, and it's a hard one to explain. But once you explain it, it's actually I think a very provocative and interesting idea. And I should note that we're hoping later this fall that Dan's been working on some new household projections, which is something the Joint Center does, and we're planning on having Dan present that I think in early November. Um, I was struck, and several of the folks in different ways, I think, were struck by some questions, and a little bit more optimistically, you listed, I think it was 6 or 7 states that have really changed the rules that localities have to play by, that either eliminate or reduce the amount of discretion they have for single family zoning. And I'm wondering, um, have you had a chance, you or your colleagues had a chance to look at, do we have any sense yet about whether those policies are having any significant impact on production, and then in theory, perhaps on prices?
I would say more, to come. I mean, a lot of these are new laws that's hard to measure too. I mean, what initially comes to mind, right, is the extent to which accessory dwelling units, are huge shares of new housing units coming online in places like Los Angeles, right? And so kind of enabling these alternate types of units that are potentially, more affordable. It does appear, right? In our, yeah, the work so the ADU, not the ADUs are an easy number to come by, right? But what, the work that we have at the center, right, has points to places where you can measure it, and it has been a measurable growth, measurable part of new housing stock in some places, compared to other places, right? With that haven't seen a bump in accessory dwelling units due to inadequate incentives or finances or other kind of code laws that are getting prohibiting it still, so I think that's a growing area of measurement, right? Is how much are these having a role? But I mean, one thing we can tell you is places where things like manufactured housing are illegal don't have manufactured housing, right? So I mean, it's like you can see the opposite. So these rules are gonna start to make a difference, in a hopeful aspect. I'm hopeful.
One last two-part question. Um, as you went in, is there anything in your findings that really particularly surprised you? I mean, I think you went in with a sense of what was going on, but anything that was either much bigger or much smaller than you thought. And then the second half of that is, um, within a few months, you'll be starting to really do the deep work on the next State of the Nation's housing. And I'm wondering if there's anything in particular that, given what you're seeing right now, that you're sort of curious to really dig into. So
Oh,
surprises, and what are you looking for?
right. Well, surprises are hard because I mean, working on it for months and then updating it, and so what is surprising? I mean, I mean, but it's an easier question for me to answer, so I'll go with that. So, I mean, surprises, totally shocked. I mean, but all the surprises are like, you think about it and it's like, well, I guess that makes sense. This is not great. Thinking of specifically, shocked that the homeownership rate gap between whites and blacks was exactly the same as it was in Q1 of 2024 as it was in Q1 of 1994. Shocked, having covered, all the approaches that are happening, the kind of state housing finance agency, and the emergence of the special purpose credit programs to kind of address these long-standing, inequalities in access to homeownership. And so just seeing that was just eye-opening, combining that with kind of research we've done saying, you have a lot of barriers, credit, wealth, income, and we had a paper on really before this surge in interest rates, the income barrier, the ability to have the income to afford the monthly payments was a big barrier in efforts to improve access to home ownership among Black and Hispanic households, and the income barrier has only increased, right, since with interest rates, because it's all about the impact on monthly payments. So I think that's kind of a downer, but it was just like surprising, and it's like, what can we do? What can we do as researchers, as humans, right? To kind of try to see what can we, what would make a difference in this environment, right? And how do we see the world and help to make the world more closer to what we envision it, in a perfect world. So that was something. That's a little bit of a downer, but I don't know. We're out of time. We're kind of a joint.
Well, it is a downer, and yet it's also, I think, a wonderful reminder that we all do this work in part because we actually care, and we're still trying to get to that wonderful, now what, almost 60-year-old, more than 60, almost 80-year-old goal of decent and affordable and safe housing for everyone, going back to the 48 Housing Act. And it's rereading the report to get ready for this, I am just again struck by the unbelievable landscape that gets covered in a relatively short amount of pages, and that you can keep this all in your head. And then to remember that we do this because we care and we're trying to, move the needle. So on behalf of all the folks here online, just to thank you and your colleagues for just the amazing work that this report represents, and look forward, hopefully for both of us, having this discussion again, and look forward to seeing many of you at our upcoming events, all of which, I think all of which are online, some of which are hybrid in person for those of you who'll be in Boston. And I hope everybody joins me in thanking Dan and the team behind the report, and the team that makes it possible to do these events. Thank you very much, everybody. Have a great afternoon.
Thanks, David.